Hi, Amit. Welcome to Venture with Grace.
Hello, hello. Glad to be here.
Awesome. To start the show, I want to give a quick shout out to our sponsor. This episode is brought to you by LG Nova. Get ready to ignite your passion for innovation at the fourth annual InnoFest, happening at the iconic Palace of Fine Arts in San Francisco on September 25th and 26th. This two-day event brought to you by LG Nova is your chance to dive into the future with industry leaders and cutting-edge startups shaping health tech, AI, clean tech, life science, smart life, mobility, and more. And here's something extra special. I'll be hosting a panel at InnoFest, guiding a dynamic discussion on the future of AI and the workforce. Join me along with other thought leaders as we explore the trends and technologies driving innovation and positive change. Don't miss out on this unique opportunity to be part of the conversation and help create a brighter, more innovative tomorrow. Register today at alginova at innofest.alginova.com and be part of the movement at InnoFest 2024. Okay, to start the show, I want the audience to learn more about you. Maybe we could start, maybe even prior to Clearbit, what were some like core lessons that you've learned early on in your career or life that kind of shape you into like a fund manager today?
Yeah, let's see. So it's been an interesting ride to this point. So I have been in tech pretty much my whole career. I studied engineering in school in the Bay Area, and then went to a really tiny company as one of the first 10 people at a company that ended up raising from Sequoia, and we ended up selling to a company called Dun and Bradstreet. That was actually part of what the inspiration for what ended up happening at Clearbit and why Clearbit was what it was in terms of a data product. But yeah, it was around startups from early on. I think I figured out pretty quickly about myself that I was, I don't know, I guess not that employable by a big company, and was not a big company person, and kind of loved risk taking and really doing a lot of things at once, and context switching and being a jack of all trades. And I think there's honestly no better place to do that than as a startup early employee or as a founder. And to me, that was exciting. I think some people don't like context switching and do a lot of different things. I found about myself early on that I really was quite good at it and enjoyed doing it. So it led into startups, and being in the Bay Area around the early 2010s. That was when things were a lot in software was really happening then. So it was pretty quick to get into all that.
How did you like? I want to double click on you were at this startup for like you were like the first 10 employees, and then it was a AIML startup for B2B marketing and sales. How
Yes.
did you kind of like pick that startup to join, and um, what were like some core lessons that you've learned at like a fast growing startup that eventually IPO'd or
Yeah.
like acquired into a company that IPO'd?
Right. Yeah, it was bought by Dun and Bradstreet, which is pretty big. Yeah, it's a good. I wish I had a more scientific approach for how I picked them, and it's funny how much of an impact it had on the rest of my career. That choice, because it had quite an impact. I will say I didn't pick it overly intelligently. It looked like it had a very strong founding team, and I went to Stanford for undergrad. I had a number of Stanford alums, some really talented folks who had been in pretty senior roles at McKinsey, who had then spun off this practice. So I felt like these were people I could learn a lot from, and had an edge and an insight that was sort of well earned, versus somebody who maybe was just doing something they didn't have experience in. So it felt like a great chance to learn and contribute, because in my mind, why be anywhere if you're not actually important and doing something important? So that was part of what drove me there. But I didn't know a lick of SQL. I didn't know anything about ML. I mean, that was ML. I guess now it'd be called AI. But I didn't really know a lot of that stuff. But I kind of just figured as an engineer, I could learn it, and would kind of gravitate towards the things that I thought were cool to know, and fun to learn for the rest of my career.
Amazing. I feel like it's so important to like kind of like pick the people instead of picking the like a company per se. Like quickly say hi to the audience. Hi, Amr. Amr. I don't know how to pronounce your name correctly. Sorry. Anyway, so I wanna maybe like start with like since now you're the managing partner of Earl Grey Capital. Why don't we start with like, what is Earl Grey Capital for the audience who may not be familiar with? And you guys invest in API first startups among other like SaaS companies. Why don't we talk about like a little bit of like the overview of things that you invest in and you're passionate about?
Yeah, of course. Well, the biggest, the biggest, I guess, filling that we sort of didn't cover yet was my what I did after being at Lattice Engines, which was be one of the co-founders at Clearbit, and that was an API first data company. And that I'd say is, without question, the kind of most important thing I've done in my career, including venture. And because that, of course, was a company that got to some meaningful scale. We got to around 40 million ARR. We started the company in 2015, had millions of users, and then sold to HubSpot last year. And so doing that was, of course, something where, I'm sure we'll get into a lot more of that. But that was really part of why I'm now doing venture, being a founder, actually going through it, being a builder. Myself and the other folks I run Earl Grey with, they also were part of the co-founding team at Clearbit. So Alex MacCaw was our CEO at Clearbit. He was one of the first 2 engineers at Stripe. And then Matt Sornson, who was originally our CMO, then took over as CEO of Clearbit during the acquisition, is now an executive at HubSpot. They're part of Earl Grey as well. I'm the managing partner, but they're minority partners. And together we A, love working together. B, I think believe that founders should be the ones investing in other founders and backing other founders. So people who've actually been through it and built. We thought that we saw a lot of that, folks like that being very successful. And again, thought we could do a pretty good job at finding great founders, supporting them along the way. That's something that, of course, we love doing, and I really love doing. And yeah, that's ultimately what led to being kind of on the other side. So it's kind of fun to have been on the employee side, founder side, LP side, and GP side. So I've kind of seen it all.
Totally. I feel like what I thought was there, I feel like Clearbit is like a successful company in the API first space. So for that, I guess for the audience who may not be familiar with, why don't we start with what is Clearbit? And for the API first startups, what would you say it would be like? What does the landscape look like, and how is it different from, I guess a regular startup that has an API?
Yeah, good question. And sorry, I realized I didn't answer your question, that part of your last question. So what we focus on at Earl Grey is, again, a little bit different than I think a lot of other funds. Now, many funds have focus areas on whether it's stage, whether it's type of company, whether it's type of founder, whether it's geography. Our thesis is more, and we've sharpened this over time. When we first started investing, I'd say it was a little bit more broad. Things have gotten more acute over time as we realize where we're uniquely good at identifying, DDing, as well as helping founders and having a great reason to be on their cap table. So we look at Earl Grey for API first companies and platforms and technologies. So what the hell does that mean? So largely, and I'm not sure what the familiar is with the audience. I'm positive that probably anybody listening to this knows a little bit about what APIs are. But really at the heart of what we're looking for thematically is, one, is there some sort of new technology that is then creating a lot of new product functionality and a lot of new technological functionality? So OpenAI is a great example. Everyone knows ChatGPT, but the API is really what foundationally is very valuable. I mean, there are thousands of companies being built because of what they've built. And I'd say, Crew AI is a company that we invested in out of our new fund that's doing that for agents, for the agent space. I mean, literally, we're seeing them, new companies built on top of Crew constantly, as well as consultants creating new value. So we like categories of things that make it easy to build on top of for really new and interesting things. So that's kind of one example. And the second example is more like Clearbit, and it's a good segue into what we did at Clearbit, is taking something that is upstream, pretty complex, but making it very easy for a developer to then integrate. And so Stripe did that for payments. Plaid did that for connecting with banking accounts. Twilio did that for SMS. At Clearbit, we did that with data, where developers could very easily work with data for their own marketing or even within their product. And those type of companies we really like as well. So out of the fund, we typically look for, I'll give you an example. We invested in Layer 2 Financial out of the fund. They just recently announced their Series A. They basically make it so that financial institutions can accept stablecoins really easily. Now, behind the scenes, there's a lot of work to do that with bank compliance, and some of it's offline. There's obviously a lot of online work as well to convert from fiat to, USDC and to crypto rails. And so they've made it so that a developer can do that very easily, whereas previously it'd be very hard to build that. So those are the types of things we really like to invest in. And Clearbit fell into that second category of, hey, you can go grab a bunch of data and scrape the internet and do all these different things we were doing, but you're probably not going to. So here's an API for you to do it with.
I really like that, like, API first companies. Like you said, like, OpenAI is cool, but, like, the, best part is about, like, the API that kind of enable other things to build on top of it. It's kind of like, it's giving the AWS approach. So, like,
Yeah,
everything is built
AWS
up
is another
on,
great example, really.
uh,
Fundamentally, it's a new way for people to launch new companies, new types of companies, right? It's trivial to host something. I mean, when Salesforce launched, it was like on cloud was like their big thing, and AWS basically made that turnkey, so anybody can do it, right? So that's the type of thing we like. Now, what it's not, and this is maybe a little different than a lot of other VCs, what it's not is, hey, we're looking for yet another app layer, something, another, end user. Here's another, note-taking product in B2B, or here's another, app that does something for helping a sales rep be more productive. We generally don't do much at all in that world. And of course, we've seen many great companies there. And I think we're going to see thousands of new versions of that. So one thing we were pretty, I think, maybe a little lucky, but certainly are in a good place now, is because our focus is kind of more one layer above the stack of the end app. It's like, well, if you ask ChatGPT to build you an app, what's it going to do? It's basically going to reference a bunch of APIs and existing developer primitives. That's where we want to live. Whereas we think the app layer, as it becomes easier and easier and easier to build, market value will ultimately flatten out. And it's going to be pretty damn hard to predict at an early stage level who's going to be worth a lot of money, where the market value is going to accrue. And it's just going to be fiercely competitive. So one thing that I think has worked well for our fund, for our fundraising when we raised, why LPs are excited about us, why what we're doing is exciting, is because we were pretty early on to that area of things. And, not to be controversial, but I think, a lot of the VCs who are kind of living in app land are going to be in a lot of trouble.
I feel like that's something definitely really interesting to think about. I wanna maybe, like, switch gear a little bit to talk about, like, the, how this, like, kind of, like, AI shift the product and shift, like, the VC landscape. Since, like, prior to this, we had a conversation about, like, AI is kind of enabling a lot of startups that are, help them, like, making products cheaply and, like, maybe canceling out a lot of, like, human services or, like, just, like, making everything a lot cheaper and faster. What's your kind of outlook on how that will shape the startup ecosystem as well as, like, how people invest?
Yeah, it's a very big question. It's very broad. So, feel free to interrupt me if I'm rambling, but it affects it a lot. I mean, it's hard not to see, at least in the world of pure software. I mean, really anything, it's hard not to see how there's a very big impact of AI on every aspect of company building, company investing, product building, hiring, right? I mean, just kind of across every level of the stack. I think where things are going, already where things are today, but certainly where you can imagine things are going in the fairly near future, the impact's tremendous. So I would say I'm very much a believer in much of the hype. I mean, certainly, especially as our fund, the three of us are a little bit more technical. Certainly, we think some things have, get a lot more sort of hype than substance in terms of why the product is actually that interesting. But overall, LLMs are becoming, pretty ubiquitous. There's so much incredible tech being built that, again, founders can build on top of and do more with. A lot's changing. So let's go into more specifics. So, in terms of funding as an investor, I mean, I think without question, there's going to be more startups than ever before, because it's basically, every step of what it takes to launch a product in a company has basically become simple. Whether it's everything from incorporation to, deal making it easy to hire remotely to, of course, building the product. I mean, I'm sure many people here have seen what's been going on with Replit and Cursor and just kind of the idea that a lot of the heavy lifting for writing code and a lot of the debugging can be done in a way that, if I think about what we had to do at Clearbit in 2015, was weeks, and we were pretty damn fast at shipping product. We had incredible technical leadership, but that is now, trivialized in terms of the amount of time it takes, employees it takes. So if you're starting a company now, or I should say the barrier to starting a company, if that's defined by, you know, getting the legal side set up and then getting a product set up, is really, really low. So there's going to be a lot of startups out there. So that's exciting. On the other hand, of course, many of those are not going to be, the equity is going to be worthless. So as an investor, you know, the decision is there's more work, I think, required to actually have a good point of view on where you think things are going and what you look for and what you assess, both in the level of the founder, their quality, as well as the market, as well as all the basic things that VCs look for. But it's just harder when there's way more going on and there's going to be more competition. And, you know, it's just something that, again, it's made everything easier. Now, in terms of company building, you know, we're very much focused on early stage. I do think late stage venture is it's going to be really interesting to see what they do and how they adapt. But by and large, if you're a company and you can get to a critical mass of users, revenue, without a lot of funding, and you don't need a lot of capital, you know, it's going to be interesting to see what happens. I think a lot of founders go onto the treadmill of raising from VCs, and they sort of need to get more money in because they're largely unprofitable because they need to make more hires, right? More engineers, more sales, more marketing spend. It's kind of this never-ending loop. Well, those things, if fundamentally they're a lot cheaper, right? You can engineer without the people, if you can sell without as much, if you can be more creative with go to market, more lean, what exactly do you need the venture dollars for? Because you're giving up your company for what purpose exactly? And so I think founders will have more leverage based on being really efficient with how they get to scale. And we were to a certain extent that way at Clearbit. When we got to our first 8-9 million in ARR with like 3 sales reps, again, very talented individuals who I'd say were far above kind of your average salesperson, but still we got there leanly, and that gives you leverage. I think you're going to see a lot more of that.
For sure. I really like what you said about, like, you know, basically, like, right now, more and more startups are going to be started. So I feel like in the past, like, a lot of the VCs, or like even now, like, a lot of VCs are like really leaning into like OpenAI engineer left OpenAI and then immediately like got like 10 million funding and then started their company. But when you say like in the future people will be investing in people with different kind of skill set, like maybe the business people or like people can easily leveraging AI tools, like versus like the people who come from like these like really big AI enterprise. I wonder, like, how do you think about like the entrepreneur's background shift in the future?
Yeah, it's a good question. I admit I don't think I have a perfect answer yet as to what the most sort of venture investable or most valuable archetype for a founder will be. I think some things, you know, the more they change, the more they remain the same. I think some things have stayed the same, where are you really working with somebody or investing in somebody who has a big vision, or are they looking to, you know, hit a single or a double versus really a grand slam? And is what they're doing really technically or otherwise ambitious? I think that's something that, again, you know, not to, I feel bad saying this for any any like lightweight, you know, sales app companies, but like, are you building yet another sales app that is going to be somewhat limited in terms of potential, or are you building something really groundbreaking? I think part of why, you know, there's a lot of attention around like deep tech, for example, and hardware tech, is that tends to lend itself more towards that. And so I think you have to ask yourself, an investor, is this truly technically ambitious? And what they're doing is great, regardless of what their brand is, regardless of what their, you know, history of fundraising is. And so I think at the heart of it, you know, that's where, as always, you know, power law type returns will come from. But it's important to really understand that, you know, as early as you can.
I wonder, so since like you guys have invested in a lot of companies that's um working alongside with like I guess it attracts a lot of like top investors. What's your thought process on like creating a sustainable deal flow as a investor who focus on like some specific domain, for example API for startups, and then like and essentially like I guess like a lot of it are sales AI, like fintech, and in the past it was like Web3. Like, how do you think about like sourcing differently with a specific focus?
Yeah, it's a good question. I don't know if if honestly we have it's funny. I think a lot of fund managers, and this is going to be a little bit mean, but I think a lot of VCs and GPs try and go way too like sort of scientific or unique on how they find deals. Like I have a special engine. It's kind of bullshit, right? Like it's like I have a special engine that goes finds these startups and I know how to hit them. It's like great for fundraising, maybe. I mean, it sort of sounds cool, but it does. I don't think it actually translates to like the best founders. For example, I live in Austin, Texas. If I were like to say, oh, I have an edge where everybody who graduates from this high school, like I get in first. Like that's not a good denominator set, right? So it's not like it may be a different set than other people, but it's not like a great set of founders. So I think it's funny that people over bias to like I need a very unique little set of deal flow that other people don't have. I think what it really comes down to is, in our case, right, and this is not for everybody, but certainly for us, it works. And I'd say it also works well for, other VCs who've been very recently or actively are building or founders. It's like, have you built stuff that people respect and they know what you're doing and they kind of can say, hey, there's parts of that company that, if this person was on board with us, we could try and emulate. And do they know what they're talking about? And so in our case, I think that, reputation with other investors, with other founders, I mean, overall, including our angel portfolio plus our first fund, we're now in our second fund, we've backed over 100 companies. So we've got a pretty big network of folks who, hopefully and I'd like to think we have, done really right by founders at every chance we could. We've shown that we know our stuff and are pretty valuable. And I think that just compounds organically and people wanting to refer us. Having a focus area honestly has helped too. I certainly would say that, I've seen deals over the years where it's some hot consumer thing. And I'm like, look, to be honest, I don't, you're referring me into the deal, but I don't really have a great argument to the founder for why he needs to be on the cap table. Whereas something in our world, I think we've got a pretty good chance. So I would say in our case, it's really been from from a decade plus of kind of being in this world and having actually built in it gives us credibility to see deals from other investors, maybe sometimes who want our thoughts on a deal, especially if it's kind of more in the weeds, as well as from our founders and portfolio network. That's honestly where we see the best stuff. I think certainly we have some tricks given that, we know data really well. We've built a data company. We have some tricks of things we like to look at within the fund. But I think really there isn't some like, oh, we outbound every API company based on GitHub repos. Like that stuff's all kind of bullshit, in my opinion. Most of what we do is based on, I think, what we've actually done in our careers.
I agree with you. I feel like a strong like personal track record or like a track record that's like related to like the result from your like operating a company. I feel like that's speaks a lot versus like there's like a specific pool that you're drawing from or something.
Right.
So I wonder when it comes to like fighting over these like really top deals like that are eventually invested by like these like top companies. Like I think first of all, like what would be your like were they coming for example like a Crew AI or something? Like are they coming from inbound or like do you have the outbound when you hear about them like from a really great signal investors? How do you kind of source these like the top tier deals that you have invested in? And like what are some like diligence process that you were using to kind of evaluate if they fit into your investment bracket?
Yeah. So let's actually look at some specifics. So Crew AI, we were actually one of the very first, if not the very first check into the first round. We had a relationship with the founder. He actually worked with us at Clearbit. So, we actually were some of the folks said, hey, I think you should start this company because he had done some work in open source that we knew well and kind of saw where things were going in terms of agents and believed in his character and his work ethic and his ambition. So, we were early on, and then fortunately the round became very, oversubscribed. And that was, again, maybe we had a little bit to do with the signal, but mostly it was just Joao doing an incredible job and building a great project. So, really just that's an example of just through network. They've gone on, they're going to do a big launch. I should plug Crew. They're doing a huge launch very soon. And they've had a phenomenally successful time with early customers and early users. Another company, again, I mentioned Layer 2 earlier, the CEO's brother is actually the CEO of AngelList. And, we're pretty close with that community. Naval Ravikant was and his brother Kamal were early investors in Clearbit. It was part of why we even got into doing a fund in the first place. They had worked with us before. And so that was, sort of in network. Hey, you guys are pretty technical, PI first companies. We had a brand around that. It was while I think crypto and Web3 was sort of a bit of a punching bag, but I think we take pride in making kind of independent decisions without just kind of going with whatever other people thought. And we were like, yeah, this is pretty great. We think stable coins are one of the best products in crypto, and the rails for that are very important. So we were early in there. Again, they able to raise from others after that, but we were referred into that one by, again, somebody who knew that we'd have a very good opinion on the business. Let's see what else. With Ruby, which is our newest investment out of the fund, a 4VC was the lead, and we were brought in by another investor who was involved and said, again, you guys, the space, I think you'd have genuine value to add. And what's nice about our fund is we're a small fund, so we're not nearly as competitive as, let's say if we were a $100 million fund. Earl Grey 2 is only 15 million. So that allows us to be collaborative, if there's a lead, if there isn't a lead, if there's others involved, not. So that's, very acutely why we've kept our fund small as well. We know that, our bread's buttered a bit that way. So yeah, I would say it's a combination of things. But that's what's good about it. I think it's hard to say every good deal is going to come from one place. Sometimes from a co-investor, many times it's from founders and actual builders. Sometimes it's things we see uniquely in our network, like Crew, and it's like, oh, this should happen, and we can pounce on it early, and then things will the dominoes will fall after that. So I think having a lot of different sort of tentacles and opportunities flowing your way through different channels is actually the best way to see a lot of deals.
I totally agree on so having an edge in a specific domain and then attracting people through your network to kind of sending you relevant companies that can leverage your expertise to build on top of it. I wonder when it comes to investing or having basically portfolio construction, what's your thought process on how much you would leverage to invest in as early as possible, or do you have a mandate on here's the valuation we're shooting for, or a strict cutoff to be we'll never do a second round, third round? I know that you guys also invest in later runs. How do you think about portfolio construction, and if you would do follow on rounds for a particular company?
Yeah, it's a topic that I think is there's a lot of great stuff out there. Like our anchor LP in the fund, Sindana, Michael Kim, he puts out some really awesome stuff on how, with real data they've seen. I think it's a lot of kind of again, very high level kind of bullshit theater of in VC of this is how you should do your fund, or this is what's worked. But the timelines are long. So unless you've actually been in it and been through exits, either as a GP or a founder or as an LP, you don't really know what you're talking about. I would say that, Michael and Sindana, they've done a phenomenal job, and they've coached us a lot on this too. I think we may know really well how to talk founder. And I'd say at this point, we're pretty damn experienced on the VC side, but going into it, we don't really know. And even now we're not nearly as experienced as somebody who's done VC 10, 20 years. So I would say certainly, there's some really good people to learn from on portfolio construction, and we have as well. And we're constantly being coached by many of those people. That's probably the biggest area I ask for advice, because the puck is moving, right? And things are moving. I would argue that, especially with AI, for example, if you were to look at the expected value or probability of a pre-seed company to get to revenue, let's say, so pre-product, I think 5-10 years ago, you would say that, that's X percent. That's a pretty low percent. I think now, given what we talked about with the advances in AI and how quick it is to iterate through products to get to product market fit, how easy it is to, get to early adopters and users, assuming you're fairly high margin, that probability is significantly higher. It's probably 3x now. So what does that mean in terms of whether you want to be more of a pre-seed or a seed fund, right? So for us, for Earl Grey, we like to go pretty early. I would say when we started or decided to do a second fund, in my mind, I thought we'd probably do more seed. I think as we've seen things evolve the last couple of years, we've been very cautious in deploying. We probably will end up doing more pre-seed than we thought we would, or more inception rounds, as Ed Sim of Bold Start has coined. And so I think, again, that's somewhat a function of where we think there's more return alpha. It's also somewhat a function of the fact that we think, as I said, there's arbitrage in a great founder being able to iterate through to interesting product market fit much faster and cheaper and leaner than before. And it's because I think there's some risk of what's going on in growth stage venture. So, there's going to be some companies that are great and raise very little money. In fact, I won't say who, but one of our companies from Fund One, who's making, I think, the most in revenue, they only raised $2 million, and they're going to end the year at around 80 million in revenue. And I think, I think you're going to see more of, that's an extreme example, but my point is that I think getting in early into rounds with, really, really top tier executors and founders, those could be really some of the only chances to buy equity. So I think that is where this fund will go more. But that's not what I would have said if you'd asked me 2 years ago. Said, I'd say, no, we like seed. We like to see more product market fit. We like to see some revenue. My biases have changed over time. And I think that's, important to do as a GP and a founder, is kind of like, be willing to change your opinion on things.
I wonder, since like you have been a builder in the past before, so like what would you say, like how would you build a company differently if like you and I are starting like a Clearbit or like a company in the B2B SaaS space? What's your advice to, like where would you splurge on versus like where would you like actually just like basically where would you like spend the engineering resources to build versus like what would you just like use the existing tools like an open API to kind of build?
Yeah,
Or like maybe the marketing too. Like, so since like you're the chief business officer, like how do you think about like the marketing revenue side of things when it comes to building an AI product?
Yeah, that's a great question. And let's kind of remove the prism of venture for a second, right? Like people shouldn't build companies to optimize for venture funding. They shouldn't build companies because, what's venture backable or not. I mean, it's almost kind of crazy that a lot of people think about it that way and say, okay, what should I focus on so I can raise a big round or be easy to raise money doing? There's obvious answers to that, right? If you do stuff around, AI, for example, versus like, newspapers, it's like, yeah, sure, you're going to raise more money, and it'll probably be easier to raise because, fair or not, VCs are very kind of market and signal driven more than they'd like to admit, at all stages. But at the end of the day, start a company, you shouldn't be thinking about that. It's, in my opinion, because today you can build a really phenomenal company and frankly make a lot more money, even if you don't raise VC, right? So VC is a tool for a certain type of company, a certain type of outcome. And so to answer your question more specifically, I first wouldn't start with like, okay, where should I allocate money or resources? I should start with like, what's a problem I'm passionate about solving? What's a customer type I'm passionate about helping? What's in something that I've maybe earned the right to create a solution around that bugs me, doesn't exist, and I'm going to be passionate enough about that to work on it even when it gets really hard, and I'm going to grind through it. Now, in some cases, that may be a side project. In some cases, that may be something you go full time in on. I will say that even with AI, what's probably as true as ever is the more you put into something, the more you get out of it, right? There aren't shortcuts. So just because, you can debug your code faster, it's like, well, are you obsessed with this thing or not, right? And that hasn't changed. It's more just that you can do more faster for certain things. So I'd say, if you're all in on something, you'll know it and really feel it. And if not, then that's okay, right? There's a lot of incredible businesses that actually can make more wealth for people, but they're not venture scale. So I'd say you should start with like, what are you trying to do and why? Now, if you're trying to build robotics and you really need a lot of capital for that, then yes, I think clearly that, you're going to want to hire, especially if there's a real core kind of technical innovation that you're working on. I mean, you're going to need the horsepower to give that, give yourself the runway and the ability to find that innovation or take an idea and take it to actual prototype or actual something, right? Whereas certainly on the distribution side, I'd say probably the right answer is, find something that works, or if you have something that works and you have a clear line of sight into how, more marketing, more sales can help you do that, then sure, go and spend on it. But that's, pretty generic advice. And that's the same whether you're, pre-AI, post-AI. So yeah, my kind of bigger reaction is more think about first the type of business you want to build and why, and then that should dictate where the capital is allocated. Certainly I can speak to the Clearbit side, but for now I'll stop talking. But that's kind of my general reaction to that question.
Totally. I feel like it's super varies, like company by company. When it comes to investing, by the way, hi Ryan and Emma, we're gonna address your question at the end, hopefully. So when it comes to like in terms of like marketing, since like I feel like I listen to your like other podcasts, that's kind of like a marketing master class, or like I guess like sales master class for people. I feel like um, I wonder like what are the kind of tools or like go to market strategy you would use if you're like marketing a B2B SaaS startup right now. Maybe we could use any of your portfolio company, or a company that like you think like everybody knows. Like how would you kind of, not everybody know, that probably doesn't require marketing, but like maybe we could use like some imaginary scenario on like a particular B2B SaaS startup that right now, if you're trying to do their go to market to trying to maybe sell like a 500K product to a company with a 40K budget, how would you kind of like go about it?
Yeah, that's here's the reality of it is there isn't one size fits all. One thing that was kind of cool at, of one thing cool about Clear, at least I found cool, was, we were basically like the arms dealer for growth hackers at all these different types of companies, whether it was a super enterprisey company. I mean, pretty much every B2B SaaS company used Clearbit. Again, mostly B2B, not consumer. But we saw within that open source first models, freemium models, PLG models, pure sales models, super enterprisey models, services heavy models. So we kind of saw how people used our product for a lot of different types of growth motions. And the good news is I think that, companies, there's still a lot out there. And I'd say, again, frankly, now as a buyer of software or even a builder of software for your building your own internal tooling, it's kind of an amazing time because, there's so much, as I mentioned, there's so many options out there for, marketing made easy, landing page made easy. Like AI has kind of, proliferated a lot of new tooling for growth people to be creative with, or even build internally, right? Like with Retool, Replit. I mean, the things that are happening now, it's an incredible time to use software to forego to market in very creative and scientific ways. But to answer your question, I think the number one advice I've given a lot of our founders, and again, we're very lucky to have seen our portfolio companies, do it in a lot of different ways. And hopefully, along the way, they've listened to some stuff we told them and what have you. But I'd say, the generic advice I'd have is, play to your strengths, like, and understand kind of your, really understand buyer expectations and mindset. So don't predetermine hell. Well, I like to buy stuff via product-led growth and freemium. Therefore we need to do that. Well, does that match what your buyer wants? Does that match, is that going to give you ACV? Like, based on your market, like if you have, only a few potential customers, you're probably better off finding a way to do an enterprise sale there versus saying, well, I want to make it easy. Unless you bake that into your strategy, you're making it open source or free, and then you go and sell them $1 million to self-host, right? So I'd say that today, I think, look for great leverage through, of course, social media, distribution, newsletters. I mean, those are all very cheap ways to build out community and attention, right? Attention is hard to get. I will say that, certainly we've seen a lot of founders with big audiences not be all that good at growing revenue and being good at that. So, sometimes people have lost the plot a little bit where it's like, I'm care more about attention and followers than I do actual product market fit. So don't go too far down the ledge that way. But there's some incredible CAC LTV ratios from founders who've found the right balance there of like, okay, I'm going to leverage my audience and build an audience and brand around something that, these are people who already are excited and nodding their head before they talk to you. That's going to lead to a faster conversion cycle. If there's easy ways for people to try your product or a part of your product, that's going to get them value. They're more excited to talk to you, right? I mean, these are kind of basic things, but I'd say, think about leverage, right? Don't just think, okay, well, we're going to dump money into ads or we're going to spend money on sales reps. Like, think about ways to get leverage first. And there's so many new ways to do that. And then second, play to your strengths, right? If you're great at shipping product, then maybe we did this at Clearbit. We had, again, incredible product and technical leadership. We built a lot of free products, and we knew that those were kind of good flywheel and trust builders for ways to then come in, and we could convert them very fast for the sales products. Again, we see other founders who are good at building brand, like leverage that. We've seen others who are good at leveraging partnerships, right? We can then sort of piggyback on somebody else's brand, but you got to be good at giving value to the other brand. Certainly, open source is a model that I think we'll see more and more of. Easier said than done to go from open source to paid, but certainly I think especially in the developer world, you gain a lot of street cred doing that and doing that well. Again, Crew's a great example of that. And then for sales led, again, I think Clearbit, one thing we did well was kind of meld the best of kind of a high throughput inbound channel with best practices from sales. So we didn't actually, people thought Clearbit was very product led. We certainly were in terms of lead gen, but our explosive revenue growth really came from sales conversions. Like, we would talk to people, they wouldn't be able to just buy something for, 20 grand a year. They'd have to talk to somebody, but we'd make it easy, make it fast, and maximize ACV, as opposed to being purely self-serve. So I think adapting to the buyer, to your strengths is very important. And that's going to differ for the different type of company as well as the type of buyer. But the good news is, again, there's a tremendous amount of tooling and ways to do it with probably higher leverage than ever before.
I feel like what you said were some of what you said were really interesting. So for focusing on your strengths, if your strengths is like shipping product really fast, like maybe you just ship product to get ship free product as like a marketing funnel, or like if you focus on partnerships or like whatever your strength is. I wonder, when it comes to building a fund in general, like how do you think about building a brand for the fund versus I guess if you, let's say, if you focus on on a particular trend called like crypto or AI, I feel like that kind of shifts really fast. How do you think about having built a longevity with your brand and with a strong focus, but also when the focus shifts, how do you make sure that your brand don't stably associated with one trend that kind of fades?
Yeah. Well, okay. So on the VC brand side, I mean, first, let me start by saying way too many VCs care way too much about their brand. It's extremely frustrating. And I promise you, founders don't, good founders or people who actually know what's going on, they're not enamored by the fact that you have Twitter followers. They're going to respect people who actually have, accomplished something, right? So it's it's crazy to me how much brand is put on that. I mean, maybe that works for LP fundraising. I don't know. But it's kind of way too much focus is put on look, it's part of why people make fun of VCs. It's they're just this, thought leadership. I don't do, we don't do a ton of interviews and this and that. It's sort of by design. Founders should come first and foremost, right? The people building should be the ones getting all the shine and all the attention. And so first and foremost, I'll say I'm a bad person to ask about VC brand because we don't do a lot there, but that's on purpose. Now, in terms of the brand that we do value, it's more what do founders think of us? What do other co-investors think of us? And of course, what do our investors and LPs think of us? That's where we want to spend our time and attention. Now, hopefully, does that help and propagate itself for, referrals for new founders or, let's say we're doing another fund, new LPs, whatever, right? I mean, that's the thing that, we'd rather focus on than just kind of getting, vanity metrics, getting Twitter followers or whatever. But yeah, in terms of building a brand as VC, so I'm a bad person to ask because we're not good at it. We don't want to be good at it. It's not kind of the heart of what we're doing. It's we'd much rather kind of work in silence and hopefully, we don't pay ourselves salaries, so we only make a lot of money if our fund makes a lot of money, and our LPs do. But we'd rather kind of move behind the scenes and and do great deals and support our founders, and hopefully it all works out. Than build brand. But yeah, I don't know. So I honestly don't have a great answer for you because we're not that good at it and we don't really want to be that good at it.
How do you react to first of all, I think you have a great brand among like, some like certain type of founders, right? And like I wonder how do you react to like different trends? So right now, like we're on like a really big like AI hype cycle. And um do you I know like Korea is obviously an AI company, and then there's like also you guys still invest in like the crypto side of things as well. So I wonder how do you think about like the when to invest around what time of the hype cycle?
Yeah.
Obviously, no one can predict how long, if this is like a actual hype cycle or like, I mean, I think AI is staying, but like, I don't think AI is like
Right.
it should be a trend, since like I feel like internet is not really a trend. Every company is an internet company
Right.
these days. So what's your kind of like thought process on like, investing in trends, and at what stage you would kind of invest your time and energy into it?
Yeah, it's a good question because I think honestly a lot of VCs get a hard time for saying like, oh, you're chasing trends or hype, but in reality, it's part of the job. I mean, you kind of have to be, and there's no crystal ball, right? So you kind of have to be like, oh, is this a huge thing happening? And like, I kind of need to jump on it. Obviously, the counter side to that is you don't have the ability to form original thought around a deal or an evaluation of technology. And so you're just going to kind of tail, other VCs, which I think certainly um, I've been guilty of at times. I'd say that hasn't worked out that well. So we've gotten much better. And I'd say with pride that we're very good at combining kind of what we understand about a trend or a trend line, or what other people are saying with our own kind of analysis of something. And layer two is a great example of that. Everybody hated crypto in 2022, 2023. All of a sudden people like it again. We were kind of like, look, we think stable coins are incredible. We think they're the best product, one of the best products in this market, and we think that doing this is really hard. And so they're making it easy. So we kind of stuck to our guns and again looked at the quality of the founder and what we thought was a trend line that probably was not quite taking off yet or had receded a little bit because of general market sentiment, but very much was real. AI, I like to think we're a little bit the same way, where we've been very slow. We've only invested $2 million out of our $15 million fund ish. So we've got a lot left to deploy, but we've been slow. And some of that's been because we've not liked a lot of the shape of the deals we've seen, either in terms of valuation based on where they actually are versus a trend that we thought needed more time to mature. Like there's so many categories of companies we'd see, like fine tuning an open source model that like we said no to, and a lot of other investors invested in. But, we kind of looked at it and said, look, we've worked with LLMs before. It feels like context windows are going to get bigger. There's going to be more LLMs. There's going to be general purpose models are going to get stronger. Like we don't like this category. It doesn't make sense to us. We don't really care if other people like it or not. So I think we like to, but at the same time, agents, for example, we think that's one of the biggest, most interesting pillars, and rightfully is receiving a lot of hype. I mean, it's incredible what you're going to be able to do. I mean, to have, almost like a bot go and, schedule travel for you and make transactions across multiple different APIs and different parts of what you as a human would do. I mean, that does feel like a major, major, major category to bet on as an ultimate manifestation of when LLMs get even better, especially with reasoning and things like that. So there's certain trends I think we like to think about and deeply understand. So I guess I'm rambling a little bit, but the short answer is, we want to kind of have a really good reason and thought around something ourselves based on our understanding, ideally our experience building. I mean, part of what's beautiful with having Matt and Alex, help run the fund with me is they're actively building, right? I'm spending most of my time investing. They're actively building with this stuff every day. So, forming kind of your own opinions on categories, companies within those categories, how hard this thing is really to build. We then meld that with kind of bigger trend lines. And so hopefully that's, hopefully making decisions. But yeah, sometimes that means we may invest in a deal that, is getting all the attention. Sometimes it may be something like, that isn't cool, but we think there's something there. So, it can go both ways.
I like that what you said about like, while you were, I guess like VCs or like investors have to react to South Cycle, but you also have to formulate your own thoughts on like a particular product if it makes sense. I'm like still in shock that like you have raised like 15 million and you guys only deploy like 2 million for now, because I feel like most of the fund managers probably would try to deploy the whole thing within like 2 years or something. I wonder, when you're evaluating different deals, like what's your diligence process look like? To have your own like original opinion on things when things are, for example, crypto are like not doing so well right now. Not like
Yeah.
doing so well. I feel like it's doing better than the most recent period, but it's like compared to like the 2021 or 2022 era, it was like a different state.
Yeah, we built some pretty clever internal tooling of where we'll kind of look at, the ability to test products and again, try and figure out who users are and go talk to them. We'll do stuff like that. That's pretty normal. But generally speaking, it kind of, it changes whether it's pre-seed or seed, based on what we'll kind of triple down on evaluating. Like at a pre-seed context, if it's even just an idea or a prototype pre-revenue, we'll look hard at the founder, right? We'll look harder at references, at an understanding of what they're trying to go after and why, where are they at in their career, what have they done, and we'll do a lot in terms of referencing, as well as trying to just understand the team they're trying to build, the level of ambition, and again, hopefully it's a place or a person or persons where we have experience and network already. So we'll bias there, I think, more. Whereas seed, we of course will do the same, but we'll also look at what about this do people really love? What do they not like? What are competitors? What are kind of more classic kind of market state stuff? And ideally, again, talk to customers and talk to users either directly, referred, or behind the scenes. And yeah, I would say generally, again, as if something's open source, for example, obviously we'll look at the code. Sometimes even if it's closed source, we'll take a look at the product in a pretty deep level. And yeah, I think at the heart of it, we want to answer the question ourselves of like, how hard is this to build? What will they be doing? What is the core innovation here? Like Archetype is a company I haven't mentioned here today yet. They're a new company out of the fund. Jeff Bezos went and sought them out and invested in them recently. They're incredible. I mean, they're building basically like a large behavior model. So it's like an LLM, but for sensor data, like a camera, audio, radio. And what they're doing is difficult. It's very difficult. And they have an incredibly credentialed team doing it. And it's type of thing that, we're very confident saying that, maybe sure, some huge company like Google may try and do it, but it's not going to be easy for a lot of the startups, both based on domain expertise as well as kind of what they're doing. So in that case, again, we'll look hard at what is it actually, how well can we understand it? We'll obviously reference and do quite a bit there. So yeah, I'd like to say, I don't think we're like overly unique in what we do, but certainly we have kind of on our internal scorecard things that we will bias to a little bit more. And I'd say generally speaking, we do more with kind of repeat founders and people who are already a little bit more experienced, just broadly speaking.
How do you like like I know the Archetype company, the person were like the director of engineering at Google, like, so I feel like there's a lot of kind of like signal that's like this could be becoming something. And like when it comes across like a lot of like these experienced leaders from like a matured company, I wonder what's your thought on like filter out like who you should back or like not
Yeah.
back. I feel like it's hard to tell because a lot of people have really great experience in the past. Like, how do you think
Yeah.
about seeing through on like this person's ability to come to build like
Yeah.
a successful startup?
So the funny thing is, Archetype is actually a bit of an outlier. I actually generally think there's a pretty big difference between a startup person and a big company person. And we actually do not like to back nearly as often big company people. Now, again, that's mean and it's generalizing, but this is a general answer. We actually think that they don't have startup speed. They kind of bias to like, meetings and bureaucracy, and they're not just like, I'm gonna, fuck things up and like go fast and like that. We just think there's actually a big difference. So Archetype was actually rare in that the teams from Google, but again, they're special and what they're doing is special. And we were able to validate that. And again, I had a personal relationship with one of the founders, so it comes from a lot of other expertise about what they're doing. And again, also what they're taking on, they're uniquely equipped to do. So the funny thing is we actually don't like a lot of the founders who are like, hey, I've been at some, hot shit company just because they were. It's like, well, what did you actually do there, right? Were you important, or if you didn't exist, would the company have been fine? Whereas if you're a startup founder and you struggled and this is your second try, that may be more attractive. So, I can see why somebody like Ilya from OpenAI going to start a new company is like super buzzy, but that I think is I mean, he's incredible. I think it's more because of who he is, less than the fact that he is at OpenAI and given his serious contributions. Whereas I would not say just because somebody worked in OpenAI, automatically they're like an AI, like we want to back them and they'd be a great founder. So I actually don't like to kind of over bias to that. And we didn't really either for hiring either. I think a lot of founders find that tough for hiring. They're like, well, somebody comes from a great company, but if they weren't, like they weren't necessarily why the company was great. But that's kind of what you have to look for. Where somebody maybe started a company, struggled, they could now be onto this could be the one that's huge, and they have resilience, great resilience. They've struggled, they've been through it, but they're really hungry, right? So, yeah, sorry, I kind of took that question a different direction, but we actually don't look at sort of just like LinkedIn pedigree, so to speak, and think it's some great predictor for founder success, honestly.
I feel like the pedigree or like the LinkedIn pedigree is like definitely um I think it's easy to like fall into some sort of like um a hype cycle, or like I guess like a hype about like someone's like past position. But like I wonder, I guess like the question be like beyond the just like being someone being coming from like a really famous company, it's more towards like I feel like a lot of people with this kind of experience, maybe they will get like a higher valuation, or like they're more easy to like thought
No
out by
question.
like other VCs. Like how do you think about like um diligencing that part as well? Like, like I feel like it's harder to put money in, but like nowadays, like I think like maybe if it's easier to put money in, you may question, would this be like a good enough company? How do you kind of like do these kind of like mental exercise to
Yeah, and look,
this?
again, I wish I had a great answer here, but certainly I think at the end of the day, your job as an investor is to make money, and you have to make money, aka multiply the money you put in by where it exits. And I think it's fairly rational that some amazing people like Brett Taylor or Ilya or others have left companies, and the first dollar in are like at like $1 billion valuation, some huge valuations. Like, look, you're betting on these are like N of one people. Now,
Mhm.
is that a guarantee of success? I mean, I think the Instagram guy started a new company and it wasn't that successful. Like, no, it's really hard to find lightning in a bottle multiple times. But should a valuation uh, somewhat account for somebody's ability and track record? It probably should. And so I think again, as I said earlier, you kind of have to couple that with an understanding of like, is there potential here, right? So if you think that this company is, IPO or bust at a $50 billion, $100 billion valuation, then buying in at 1 billion maybe isn't that crazy. But if you kind of are underwriting it more as like, okay, this is probably a 100 or 500 million M&A, and you're just trying to stack, put a logo on your wall of like, hey, I want to get in this company, then maybe you're not doing the best things with LP's money, right? And maybe you have to think about that. So, and that's sort of the optimistic side. Again, I think a lot of very smart investors are making these bets. The sort of more cynical side is that a lot of VCs are just trying to deploy capital into hot deals, and they don't actually give a shit about downstream returns. And it's sort of more of an AUM game, right? So I think all the above happens, but for the most part, I don't think it's smart to be like, well, if it's a hyped round, you shouldn't do it, or if it's a low price, you should do it. I mean, that's also like not good, right? You don't want to discount shop.
Mm,
So I think you just kind of have to take it case by case, honestly. And certainly we're seeing feast or famine behavior happen a lot early stage, where the absolute cream of the crop founders and ideas, sure, hype is benefiting them quite a bit, are raising big rounds, but and we see a lot of those. We haven't done a lot of them, but we see them and sort of have to ask ourselves, okay, would we do this? Does it make sense? And does it fit within a broader portfolio strategy? But I don't think it's smart to have a rule, honestly, on how you do them or how you don't do them.
mm. I want to be mindful of the time. I have like a quick 1 minute fire round for you.
Yes.
Okay, what's your favorite book?
I love the James Bond books. I'm a big James Bond fan. So I
What?
read all the Ian Fleming James Bond books. I know it's a weird answer.
Who would you invite to your dinner party?
Leonardo da Vinci.
Who made the biggest impact in your career?
Probably Alex MacCaw, my Clearbit co-founder, CEO.
Where can we find you outside of work?
The airport, travel fair there.
Okay, amazing. Well, Amit, thank you so much for coming on the show today. And it was so fun to chat with you.
Yeah, thank you so much for having me.
Let me quickly end stream.